the summer is over. We're into September. September's normally a difficult month for equity markets, but walk me through how people are positioned coming into it, how you advise being positioned coming into it.
Good morning, Guy, and I hope you've had a good summer as well.
Absolutely.
I think what we're expecting is a Fed rate rise towards the end of this month, which I think we will build to in terms of anticipation. So we could begin to see, as you were highlighting right at the top, that maybe the dollar continues to remain well supported, which probably then means the headlines around emerging markets, they're going to continue to struggle if the dollar continues to rally. I would say, though, that I think where the markets have become more risk-off over the summer with Turkey and Argentina, I think what, to some extent, we've been seeing is illiquid markets, rather than necessarily anything that's been truly fundamentally awful. And so I think what will be interesting is, as you said, as more and more people now return to work, to see whether the liquidity in the markets picks up or whether we're actually seeing something slightly more sinister, which is a lot of people, have got a lot of similar positions on, and if one person tries to unwind, that the markets have to move quite aggressively because the liquidity or the depth in the markets is no longer there.
US financial conditions are incredibly loose still. So you talk about the kind of the Fed hikes that are coming through, and it's sort of the emerging market story that's there. The US economy just is a closed economy. It's powering ahead at the moment. Why do I need to, as an investor, even think about what is happening in the emerging markets right now? The US economy is where it is at. The S&P is trading kind of 2,900. I've seen plenty of upside calls on that, yet people are worried about valuations. And that, to my mind, is a good thing, because it means that we're not there yet in terms of the exuberance phase.
Well, I don't know about that, because I would definitely take the other side of it. As a market, it is expensive on many measures.
Has been for a while, though.
But also, I think 8 of the 12 S&P sectors are down. So I think if you're telling me this economy is booming, frankly, I don't see that either. I think the economy is solid. If you throw $1 trillion at the economy, I would expect it to be solid, but it's certainly not booming. Nominal growth's about 5, probably going to slow from here.
Where's unemployment?
Unemployment's very, very low, except the participation rate is very, very low, or lower than average. So I don't see the boom, but I think what we've seen since April is a complete change in market sentiment. The market buys into Trump and the tax reform and the share buybacks. The market is now much more concerned that Europe's going ex-growth, Britain's got Brexit, Japan has got no structural reform, and China looks vulnerable to the trade war. So the market seems to have almost capitulated and only owned US assets. I think as I prepare for a big meeting next week with my fellow CIOs, I'm looking at the fact that US equities are up, US cash is up, and every other asset class is down. I mean, it's quite a remarkable...
But what turns sentiments around on that?
Well, I don't know what happened at the beginning of the summer, per se, other than I think the US corporates, the share buybacks, the M&A, has really been a US-centric phenomenon until we saw Costa last week.